Hi, I'm joined today by Lachlan Hughes, the CIO and CEO of Swell Asset Management. G'day, Lachlan.
Thanks for having me, Fraser.
Not a problem. Now, we thought we might have a quick chat, if we can, about some of the stuff that you're doing here at Swell. But before we do that, we might start with a little bit about you in the past. Tell us your story.
Yeah, absolutely. So my work history, I actually started as a solicitor back in the early 2000s. So I was working with the Bank of New York in London, which was like a really great opportunity for me as a guy from the Sutherland Shire. And I go over to London, I'd get a job with the Bank of New York, and 1 minute I'm walking across Tower Bridge with a file under my arm going off to a meeting. Now, it was a custody role, but I actually had the opportunity to work with a lot of asset managers at that time because the Bank of New York had relationships with all the major asset managers. We were doing stock lending agreements and custody agreements for them. And that was really what piqued my interest. I've always loved investing, but I was a lawyer. And I sort of came back to Australia, worked with Mallisons. I really started around 2006 thinking, I want to move into investing full time. This is what I want to do. At that point, I started my CFA and started writing off to various asset managers. And I wrote letters off to John Sevior and all the big asset managers, basically saying, look, I'd love to come and work for you. And the answer I'd always get back from a lot of people was, look, that's great. You want to be an investor, but you're a lawyer. You're a lawyer first. So I basically wrote off to a whole group of people, and it was around 2008 I came across an ad from Challenger for an investment role in the small cap team there. Now, it was something I applied for. Obviously went through a few rounds of interviews, psych testing, and then signed the contract with Challenger on the 9th of September. It was a Friday. I was get to be married on Saturday, the following day. We waited around for about a week because I was a groomsman at one of my friend's wedding the following Friday. So we did that. We went away on a honeymoon on the Saturday. Lehman Brothers collapsed on the Tuesday. So it was an interesting time. So I said to my wife, look, this is bad. We need to get back and I need to start this role with Challenger because I sort of moved. I tried to make the move across, but I struggled to get the opportunity. So when this came up, I was eager to get back for it. It
sounds like an absolutely crazy time.
Yeah.
Was there still a job for you when you got back?
Yeah. So we got back, and fortunately, there was still a job for me. I started on the following Monday, but at that time, the markets were melting, and all the major investment banks were kind of right-sizing their equities teams. So there was a whole heap of people who were eminently more qualified than I was take my role. Fortunately, Challenger honoured the role, and I started there. And but for me, it was a great opportunity. You got to see, how a market behaves when things go wrong. And I took really three main things out of that period. And the first one was, in difficult times, in challenging times, there's a flight to quality. And this sort of instructed the way we invest today. That was the first point. Quality wins out when the market's tough. The second one is, at that time, even the companies that were very strong, have great products, a good industry structure, if they had over-borrowed, those companies were coming up unstuck as well. So you had good companies who were going out of business. You had companies that have to raise money at very low prices. So that was the second thing. Invest in quality, stay away from leverage. And the third thing was the importance of a team and the team values. And this is something that when I started Swell, I was really keen to make up our own values. You see a lot of asset managers, a lot of finance companies today, when we look at the company values, they're things like responsibility and integrity and honesty and all those things. They're really table stakes. You need to do those things. We made three simple values when we set up Swell. And the first was, we're going to be humble, because humility is one of the most important things when you're investing. The greatest enemy of an investor is the ego. And that's why I say to all the guys, come in every day and make sure that when you come in, you check your ego at the door. So we've got to be very humble. And I think clients have said, how does that help us? How does being humble help us? Well, what I think it does is it allows us to test our investment thesis, to not think that we know everything, and always to work hard to learn, whatever it is we need to know to stay on top of these companies.
Yeah, now this is an incredible story because obviously you come from a point of view where, from a legal point of view, you've walked into a scenario where people are, as you mentioned before, the markets were melting. People are making a lot of emotional decisions, and I guess that's something that you saw pretty deeply at that time, and being able to put a legal hat or a logical hat on a lot of the stuff that was happening. How did you go? How did you do that?
Well, the way we did that, well, I always approach investments from the risk perspective first, and that's the way I've taught our team to invest. So we always look at things we look at the downside first and the risks, and then we sort of work back to the valuation. So I think, I guess one of the features of starting your career as a lawyer is that you tend to identify the risks first, and I think that's the right way to invest. If you assess all the risks and you're comfortable with them. And look, let's be honest, there's going to always be a risk with company. There's always risks with investing. So, I think it's that risk management approach which has driven a lot of our performance.
Yeah, and so was that something that you brought from the legal world, as in, with the work you were doing in the legal side, was there things that you were seeing that helped you as a fund manager?
Do you know, I don't think it wasn't something I thought about when I came across to investing. I think it's just the way that you are when you work as a lawyer for a long period of time. You do come across the risks first. As a lawyer, we're always trying to identify the risks. And I think that it's something which, when I came across the Challenger, that was kind of ingrained in the way I assessed companies, that risk perspective first. But, for us, I feel like a lot of the outperformance that we get over time is due to our risk management processes and style.
Yep. Now talk to me a bit more about this. You mentioned checking your ego at the door.
Yep.
Conversation and working with the team. Tell me why is that so important?
Well, it's just important because you want to have a learn-it-all culture rather than a know-it-all culture. And what you find is sometimes with investors, particularly when you've got things right over a long period of time, you become, I guess, overconfident in your abilities. And overconfidence is one of the things to be guarded against when you're investing. It will bring you unstuck. So you have to be humble. You have to be grounded. And I guess one of our other values is that you want to take ownership of your mistakes, because as an investor, you're always going to make mistakes. There is no way of avoiding mistakes over time. But what we do is make sure that when there is a mistake, we learn from that mistake. And what I do at the end of each year is I write down my mistakes and share them with the team, because I want them to see the mistakes that I made, and we go about fixing that so that doesn't happen again. We never want to make the same mistake twice. And to give you an example, we bought Wells Fargo before the sales scandal. It was something that it was a bad incentive within Wells Fargo, which caused the sales staff to go and open too many accounts unbeknownst to their client.
Yep.
So they were opening accounts. Now, culture was always a very important part of the process for us, but after the Wells Fargo experience, culture became even more important. And it's something that we were always focused on it, but it's got even a larger importance in the process now.
Yeah, I really do feel like that team environment that you're looking at creating, or that you have created here, is really, really important, especially because I imagine that it's very easy when markets are rising to look pretty good as a fund manager.
That's right. Yeah, 100%. And, you really know, Buffett's always said you can tell who's swimming naked when the tide goes out. It's a great thought. For us, it is during those tough times that you see how that portfolio is going to perform. And one of the things we were proud about, and why we never lost any clients during the COVID period, was there was a flight to quality during that period, and we held up significantly better than the market. But that's where you really see the value of your conservative approach. You don't see the value of a conservative approach during the good times.
Yeah, it's very easy to follow a herd. Tell me about the idea of getting involved in a bit of a herd and following along with the hype.
Yeah, that's right. So one of the things we did when the business was established was I wanted to set it up in Queensland, and the Gold Coast was something that it was well outside the capital city bubble, and the point of that was to remove bias. And and this comes to your question about the herd. The herd is something that you can be swept up in. Everyone can. If you're a human, you've got emotions, and you will always be swept up in things. Being outside the capital city bubble, I find that helps us to sort of step back from the market and to sort of apply our own I guess, our own focus, to provide our own focus on the companies that we're investing in, and try and step away from that, the herd mentality.
Okay. And so when you're doing that, you obviously need to do a lot of research. And where do you get your research from?
So we do all of our own research in-house. So we don't subscribe to any third-party research. We don't use broker research. We do all the work ourselves. So I guess one of the things that I've noticed today is we've never had more information than we have today. There's no issue in finding more data. And even we've got this additional data that's out there today, it's still not creating better investing. And the reason it isn't is because it's not how much data you get, it's what you do with the data and how you process the data. It's the insights gleaned from the data which drives the outperformance over time. And we will always do that work ourselves. We don't sort of outsource that work to an investment bank who's maybe biased because they want to raise money for some company that they're covering. So we want to do all that work internally.
Well, that seems like a lot of work. If you're doing that much work, sort of how many companies can you sort of be looking at one time?
Yeah, it's a good question. So we focus on 10 to 20 companies. That's what we want to do at Swell. We want to focus on the best 10 to 20 companies globally. Now, obviously, if you look at the entire globe, there's thousands of businesses out there. So what we do is we set a very high standard on each of those companies. We set the quality bar very high. And so when you set the quality bar that high, you immediately start to exclude thousands of businesses. And it's only the very best ones that kind of make its way through the process. And, we look at companies with a market cap of over 1.5 billion. That sort of puts our investable universe down to about 5,000 companies. And we do various things. We do some proprietary screens. We look at various factors that we know have worked in the past, and we take those companies and we reduce them down to sort of 50 companies. And then it's from that point we start the really hard work and knock those 50 down to a smaller number. We'd probably do hundreds of hours work before moving a company from that investment process stage into what I call the qualitative and quantitative stage, where we're doing all the traditional things. We're building cash flow models and which have balance sheets and income statements, and we're doing a huge amount of work on the qualitative side. So it's bringing those two elements together. Now, the types of companies that make it way through that process, they're exceptionally high quality businesses, but that's what we want. We want to own the best companies in the world, the ones that can sustain themselves from competition for a very long time.
And obviously there's a lot of probably different parts to that process that you're going through. Talk to me about that process. How is it? How many parts are there to it? How intense is it?
Very intense. The qualitative process, it wraps up everything. So, you want to look at the board composition, and you want to look at management. You want to look at the culture, but you also want to look at things like the competitive advantage and the moat, to use a term from Buffett. The moat's one of the most important things for us to analyse, because empirically we know that the moat is what stops businesses from competition. So I'll give you an example. I guess the other point I should say is we're more focused on the direction of the moat than the width of the moat. And an example of that is Apple. If you go back to sort of 28th of June 2007, at that point Nokia had more than 50% market share. 50% market share at that stage. Apple released the iPhone on the 28th of June 2007. And if you had a look at that, if you picked up a Nokia phone in one hand and an Apple phone in the other, and you compared those two products, I think it was pretty clear to say you didn't need to see where Apple's iPhone was going to be in 5 years or 10 years' time. No, all you needed to do was look at those two products and say, I think Nokia's moat's shrinking. And at the expense of a business like Apple, whose moat was clearly widening. So we're very focused on the direction of the moat because we want to know what that moat looks like in 5 to 10 years' time. We know, and empirically, we know that it's the direction of the moat which drives the most value over time. So that's a really big focus for us at Swell.
Yep. So if you just want to go into the word moat in a little bit more detail, and the distance between that company and the rest of the market. Is that what you're talking about?
Yeah, that's right. So moats come about from various factors. They might come out, for a business like Wesfarmers, their moat is the location of their warehouses. And if you and I wanted to set up a warehouse business tomorrow, we'd struggle to get the warehouses in the right location. So that's their moat. If you take a company like Pfizer, their moat is in the patents they have for the various different products that they sell. So every company is different. Every company has a different moat, and you need to assess each element in there to understand, I guess, what that business is going to look like in 5 to 10 years' time.
Yep. So you mentioned the sort of cash flow modelling, the traditional stuff, the moat concept. What else are you looking at?
So obviously, yeah, so the modelling, the cash flow, and on the qualitative side, yes, the moat's important, management's important, culture's important, but looking at things like, we like to know, the margins obviously very important. Margins drive, I guess, earnings over time. We want to understand what that margin's going to look like, and that normally involves breaking a product down to look at the unit economics of the product and looking at what is the incremental dollar that can be earned from each additional dollar of sales. So we want to look at the additional dollar of sales and break that down and see what that does to our earnings. That's the sort of intensity we want to bring. So we want to understand, I guess, what this business is going to look like. Yes, that's one part of it. But the second part is, let's look at the individual product and let's work out the unit economics so we can break it down. We want to simplify everything we do down to something that's tangible that you can touch and feel.
Yeah, fantastic. So as you mentioned, extremely intense research side of it. Tell us about starting the business at the beginning. Obviously, there's a lot of your philosophies around, the idea of, quality first, understanding that what can go wrong in a market. Tell us about starting the business sort of on day one.
Yeah, it was doing it from day one. So I've always invested and always been very passionate about investing. And one of the things I wanted to do was surround myself with people who were also passionate about investing. And I felt like I could always teach the investment process to someone who's willing to learn. So with everyone we've employed, we've made sure that they had a passion for investing first and foremost, because you really want to, I guess it's probably common sense, but you want to work in an industry that you have some sort of a passion for. And I think if you're passionate about something and you love doing it, it's easy to do the work. Work's a lot more simpler. So I knew I could teach the process to the team, but yeah, having that passion, you can't teach a passion. You either have it or you don't. And fortunately, I was able to surround myself with like-minded people, and that was a real drive for me to set the business up so that I had a team that I liked working with, that I had respect for, and that's one of our team values as well is collaboration and teamwork. It's a focus for Swell, and why is that? Because we're going to rely on each other over time. So I want our analysts to come in and challenge me each day. I don't want them to say, never questioning my models or my thesis. I want to make a culture that is very comfortable so everyone feels like they can come in and challenge each other. And I want to do that with my analysts, and I'm glad they do that with me as well, because I think that if we have that respect for each other, but if we have that ability to argue various points among us, I think that leads to better investment outcomes over time.
Yeah, I couldn't agree more. It's always good to have a team where there is rules around the idea that you can have difficult conversations and challenge each other and make sure that the hierarchy is not just leading off in a different direction.
That's right.
Tell me about starting it though. Back in when did it start?
So started in 2015.
Yep.
I commenced the strategy on the 18th of June 2015. I started in just by myself in 38 square metres in Southport here on the Gold Coast. And we've grown now to 4 people on the investment team. We've got Stephen Poole, our head of distribution, and Carol, who works on the operations side. So we've got a very good team now. I feel like we're in a good position to grow. I guess we're at circa 100 million at the moment, and one of the things we're working on is launching a fund on the 1st of July. And we're looking forward to that for a couple of reasons. But to date, we've grown amongst the high net worth market. So we've managed to grow with sort of focusing on that, I guess, the larger end of town. But the opportunity for us now is to open this product up to retail investors, but also the advisors. which I'm really excited about because I have a lot of friends who come up to me and say, look, I'd love to put in 25 grand or 30 grand. And up till now, I've had to say, look, I'm sorry, but 500,000 is our minimum. So we're excited to take it from, we're always going to focus on our high net worth clients. They're very important to us, but we're really excited about bringing this opportunity to the retail market.
Okay, so for the first 6 years, you went from investing some of your own money plus some investors' money, through to circa 100 million under management over that time. Tell me about how you've done over that time.
Yeah, the journey. So we've done very well. We've outperformed in each of the years that we've been open for investment. This last 12 months, funnily enough, has been one of our weaker periods. We tend to do better when the stock market is challenging. So we did particularly well through the COVID period. And I guess our return over the last 12 months, we're still performing well. I think we're over 18%. But you're seeing the market at the moment with all you're seeing a lot of heat in the market. A lot of the performance is being driven by either lesser quality companies or technology names which have been sort of fallen into, some of them in the meme stocks which have rallied, but also just technology names which have all sort of had a rocket put under them over the last kind of 6 months. But I guess our process is conservative. We want to own the best companies in the world. We've got to make sure we're buying those at the right price. And sometimes when the market's hot, you're seeing less opportunities. But we've just noticed in the last week or so that there seems to be a shift back out of the lower quality businesses, and this will support us over the next 12 months.
Yep. So talk to me about that moment when markets were dropping. How did you go against the market?
Yeah, so we had our best year during that. I think we were 12, 15% over the benchmark at that point. And we got a lot of comfort. It was interesting because I sat there in, must have been either late March, early April, and I said to the guys, we need to stress test all of our models. And we pulled them all out. And doing things like Starbucks is one we owned. And I guess one of the scenarios we ran was, let's just assume this COVID period lasts for 18 months. And let's assume that there's no relief for rent. So Starbucks has to pay rent and wages through this whole period. And they've got no sales to offset the rent and wages. What does that do to the business? And, we've always focused on companies which have a cash balance, a net cash balance. So we looked across our companies. All of those companies were able to survive that period. So we took a lot of comfort through March, April, May, June, when the market was kind of melting down, to say, look, it's okay. We understand this is just transitory. This is something that we will get over. And in any event, these companies can make it through this period. And for a company like Starbucks, even if there wasn't some sort of government efforts to reduce wages, bill or rent, we knew they could have survived through that period. And in fact, they would have done even better had other competitors who couldn't sustain themselves through there if they had disappeared. So we just, I guess through that period, it just was just provided more confidence that this is the way to invest. And it certainly was the lessons I took out of 2008. And I felt those lessons were valuable again in 2020.
Yeah, that's really interesting. Obviously, you're right. If it's a great company, then and it outlasts the ones that can't last, then it's going to do well.
That's right.
Tell me about you mentioned 10 to 20 companies. That doesn't seem like a lot.
No, that's right. So we really want to know our companies well. So we want to own 10 to 20, whereas our peers will own 60 to 100. But the issue is, if you've got 100 companies, even your best or even your winners, they're only just offsetting the losers. And then when you look at the performance, the management fees charged then are not offset by the extra performance. And, you see, and what does that lead to? Well, it leads to the rise of more passive funds. We get the majority of our performance from having a concentrated portfolio. Because if we find a wonderful investment and we do hundreds of hours of work and we think, this looks fantastic, why would we only buy 2% of it? If we find something that's an amazing opportunity, we want to buy a substantial amount of that company. And we're permitted to have stock weightings up to 15%. Now, it's very hard for us ever to have a company that would be at 15% because there's a significant number of, requirements to get there. But we can weight our stocks at, we probably have 2 or 3 companies over 8%, sort of 8 to 12%, and then sort of a rump around 5 to 6, and then we've got some smaller positions as well. But I guess one of the things I love about this process is you find a great opportunity, you do the work, it looks great. Yeah, we will buy that, and we will buy a lot of it.
Yeah, and do you stick to any particular sectors or?
No, so we can look at any investments. And I think this is one of the things that came out of having my start in small cap land, where every analyst who works on small caps is a generalist. They can work. 1 minute you could be looking at a miner, then you could look at a bank, and you look at a retail company. So you get you see a large variety of business models, which I think is perfect for global investing, because when you come to become a global investor, you're going to see a whole bunch of different industries. Now, the traditional structure for many global investors with large teams is that they'll have sector specialists. So, the healthcare guy just looks at healthcare. The banks person just looks at banks. So the resource company just looks at resources. So they tend to be very siloed. And the issue I have with that style of, setup is that the resources analyst isn't in a good position to compare the stocks to the healthcare analyst. Or the healthcare analyst has a very narrow view of his companies. Now, he's not necessarily in a great position to compare that healthcare stock against this bank stock, for example. And then those people progress through to becoming the CIOs or the portfolio managers, and they look at the world how they've known it to be, which is a very narrow view. When we grew the team, I wanted everyone to look at every sector. So people can come in, we can compare Google to Shopify to Spotify to Facebook, and I want us to have those conversations. But I feel like if we had been set up in silos, it would constrain the discussion we have on the topic. So, yeah, one of the great things about starting small caps is you have that broad range of experience with different sectors.
Yeah, that's really interesting. As you mentioned, coming from a small cap background and having to understand all the different parts of a small cap and then apply that to a global and large cap. Tell me about the global side of it. Is it obviously with a lot of the markets based out of the US? How do you go with the global side?
Yeah, so we one of our restrictions is we can only invest in companies that are listed in developed markets. So I'll give you an example. So like Visa is listed in the US, but it also has operations in Australia, and it's in Asia, and it's in Europe. So we have a requirement they have to be listed in a developed market, and we have that requirement because we know that the reporting standards and the governance is at a certain standard. So and it's a high standard. The US is a great market for us to invest in because that's where the best companies in the world are. It's not to say that we wouldn't invest in a company that's based in Europe. We've owned Nestle, which is obviously a business based in Switzerland. But at the moment, the best companies in the world, the most innovative companies, tend to be the digital companies, and they tend to be located in the US because it's the most innovative market. So we can invest in Europe. We can invest in any listed developed market. But at the moment, a large number of our companies are coming out of North America. But if you look at the revenue by geography, so if you look at the split by market capitalization, nearly all the companies are in North America. But if you look at it on a by revenue basis, it's about 40% in the US and 60% from outside the US.
So is there a lot of trading going on in the fund?
No, so we have very low turnover. When we do the work, we want to do so much work that if we buy the company, it goes down, we'll buy more. We don't get shaken down if the market falls after we buy something. So I tell the guys we have to do significant amount of work so that when I ask you, should we buy more today after it's gone down, you're in a position to say, yes, let's do it. So that's what, and that I think having that discipline around, how long you're going to hold a company, it makes you focus on more deeply on the work that you're doing. And that's something that we always do at Swell. So turnover is very low. And part of that is because we don't want to look at what the company is like today. We're going to see what it's like in 5 to 10 years' time. That's where I think the real value is to be added by a portfolio manager, is to looking 5 years ahead. Anyone can look at the market today and say, Apple's got this position today. Well, that's great. But what's its competitive position going to look like in 5 years? And that's where we focus a lot of our time.
Yep. So tell me about the fund that's now going to be open to retail clients.
So the fund will have an identical strategy to the managed portfolio we currently run with Hub24. So it's an identical structure, but it just means that investors who previously were kind of locked out of investing with us, maybe because they're not a high net worth investor, they'll be able to do that now. So look, it's going to be, it'll have a $25,000 minimum. And this is important because some of the stocks we invest in have very high share prices. So Amazon's 32 or 3,300 US dollars, which is nearly 4,000 Australian dollars. We have a 5% position in Amazon. So to get one share in Amazon, you'd have to have a portfolio of at least $80,000. Well, that's hard, and a lot of people don't have that much money to invest. So this way, even for our clients that will come through the advised channel, they'll be able to access the Swell portfolio exactly as it was meant to be, with 5% in Amazon, even though they're only going to have $25,000 invested with us.
Yep. So you're now working with financial advisors?
We are, yeah. So, and Stephen Poole's joined us, which has been fantastic. He's, I guess, raising awareness, because one of the things Stephen told me early on, which is very true, is, look, Swell is relatively unknown to a lot of the big investors or advisor and dealer groups. So, yeah, at the moment we're trying to raise that awareness, tell people we're out there, and sort of tell people what the difference is between a traditional fund manager and Swell. I believe we have a very unique process at Swell. I believe we bring a lot of intensity to the research process, and I believe we're taking the long-term view and we're aligned. And those elements are critical in delivering sustained performance over the long run.
Yeah. So why now? I mean, it's been going for six odd years. Why is it only sort of now that you're taking it to retail investors?
We just think now's a good time. Putting down a track record was one of the most important things we could do at Swell, because if you haven't got a great track record, well, what are you selling? So we the high net worth clients were happy to come and talk to us, and we could talk them through the process, and they could get comfortable and invest. Yes, look, that's great, but that we can't sit down with everyone and explain the process. So this gives us an opportunity to open it up to these retail investors. But Stephen's job now is to raise awareness so they can understand what our process is and hopefully join us. But I think one of the things I'd like our clients to know is that I'm fully invested. I have all my money invested in the Swell Global portfolio, and that'll never change. So alignment is it's very important to me, and I think it should be important to investors, because they want to know that if something goes wrong, I'll feel it the most.
Yep. So Swell Asset Management has the Swell Global portfolio. Is that the only portfolio that it's?
Yeah. So one thing we do is focus. We just want to work on one thing, and that's the Swell Global portfolio. So the fund will be basically the identical portfolio to the one that we have in the Swell Global managed account. It will be identical, but it just means that if you want to access us through a trust structure, which a lot of advisors prefer, they'll be able to do it now.
Yeah, okay, great. Now, you mentioned before that you're doing a lot of the research from a sort of a siloed position where you can sort of look at things from a different angle. How do you work with these companies if there are a lot of them in the US? Do you get to go in and see and find the stuff out of, or are you just relying on the research that's coming out of the market?
Yeah, so we're very different to funds. So because we try and remove bias, we actually don't want to meet with our companies. We will do all the work outside of speaking to management and investor relations. And we do that for a simple reason. So, for instance, we own Netflix, and one of the first things I did when we started researching Netflix was go and read back 10 years of annual reports, because we want to look back and say, what did the management say in 2012, and then what happened in subsequent years, 2013, 2014. And I think that's a lot more instructive than speaking to management, who will always give you just the firm line. So we want to do all of our work ourselves. And a good story is we will go and visit companies from time to time, or assets from time to time, if it's relevant to our research process. Starbucks is one that we've owned in the past, and one of the sort of the larger parts of the business, which was growing and was going to drive the valuation over time, was the Chinese retail business. And they had a big event. With the Starbucks roastery, it's one of the biggest roasteries in the world, which is it's like a huge emporium of coffee, and anyway, it's on a scale like you've never seen before.
Whereabouts was it?
It's in Shanghai.
Yep.
So the roastery was in Shanghai. So I saw that they were opening. I jumped on a plane, went across there, and I was actually there for the opening. Now, the investor day wasn't coming for 6 to 8 weeks after the opening of the Shanghai roastery, and there's a good reason for that. They obviously want to get all the teething problems out of the way before the analysts come for the investor day. And so I went across there, and it was interesting because Howard Schultz is the founder of Starbucks, was obviously there for the opening of the Shanghai Roastery, and I'd been talking to a few of the managers, and I told them I'm an investor, and they said, look, let me introduce you to Howard. So I sat down with Howard Schultz, and he said to me, he said, what are you doing here? And I said, look, I saw the roastery was opening, and I wanted to come across and see before the market gets to see it through the investor day. And he's like, I just can't believe you're here. And he goes, so what's your business called? And I said, Swell Asset Management. He goes, oh, right. And he goes, and what do you manage? I said, we manage about 20. And he went, wow, 20, that's a lot of money. Now, I think he was talking billions. I was only talking millions at the time, but I didn't correct him. And so we sat down, we talked about the strategy and where he wants the business to grow in China. And the interesting thing was, I'm there before the analysts of Platinum and Franklin Templeton were going to arrive, which wasn't for 6 to 8 weeks. I came home, and we sat down, we did some more work, and we increased our weighting in Starbucks. That's the sort of thing that I think drives real value, and happy to turn up to those types of events. But the ones that are kind of staged for investors, I don't think there's a lot of value because you're just getting the same information at the same time as everyone else in the room, and that doesn't drive long-term performance.
Yeah, I would imagine that's a bit of a marketing campaign that goes into the asset managers in that scenario. Less about the actual facts and more about the all displaying all the good stuff. And it doesn't hurt that Starbucks think you're a big deal as well.
Yeah.
So tell us about the future. Where to from here? What are we building here?
Well, more of the same. So always focusing on performance. That's like the number one goal for us as well. We want to make sure we're performing. We want to stay agile. And look, we want to grow our fund. We would make no bones about that. But we want to do it the right way. And doing it the right way is making sure that you're bringing on the right type of investors. We want to make sure we're joined by people who are also playing the long game. And because that's what we're going to do at Swell. I mean, every time we add a company, which we've just had one last week, we're not adding that because it's going to add value this year or the following year. No, it's really about the long term. So I guess we want to bring on the right type of investors. So investors, if they're out there and they want to be with a fund that's actually going to take a genuine long-term approach, but it's going to focus on performance, that's what Swell's all about.
Yeah, talk to me about long-term. What does that mean to an investor?
I'd say 5 to 7 years. That's for me, that's long-term. And the reason I say that is because that's the length of a typical business cycle. So if you think you're coming in for 5 to 7 years, you remove the element of timing from the investment decision. And I think that's really important. It's not to say that, look, we're going to knock back investors who want to come for 3 years, but my preference is that people come and stay for the long term. And look, since we've been going, we've grown rapidly, and there's only one client that we've lost over the 6 years, and they got scared about the market at some point and took their money out. But other than that, we've never lost a client. And I think that's the way I've always pitched the business. When I sit down with people, I don't oversell it. I really want to make sure that people understand really what we're doing and how we're going to invest the money.
Yeah, fantastic. And so the growth over the next few years, what are you expecting? Anything, or are you hoping for something?
Yeah, hoping that it'll grow. Yeah, because I mean, it's look, I hope people out there see us as a genuine alternative to the bigger funds. And I think we're a great alternative, mainly because of performance. You see, the rise of index funds and passive funds has come at the expense of active management. And why? Because active managers have done a really lousy job over the last decade. Because they're hamstrung, because they have these portfolios of 60 to 100 companies. They don't understand the companies very well, so they take very small bets on each company. And what happens? Well, they don't outperform, which sees more money go into passive and more money into ETFs. So yeah, look, we're trying to do something different, which is we want to be agile, we want to be nimble, and we want to outperform the market.
So the larger the fund, the more companies, the more passive it becomes.
Yes, that's what I see there, 100%.
Yeah, fair enough. Okay, fantastic. And so how can people find out about it?
So they can come to our website, swellasset.com.au. So there's a phone number there. Advisors can reach out to Stephen, and if they come through the switch, we can connect you to Stephen. And other than that, we're also available via email. Our email is info@swellasset.com.au, and really happy to welcome any discussions about investment.
Fantastic. And on the way into, if not on some of the major platforms?
Yes, that's right. So we're on Hub24 at the moment and Mason Stevens. We're having discussions with other platforms at the moment, but so we can sort of, we want to be where the investors are. So we'll go anywhere they are. So if people are on platforms, still let us know, because we're happy to speak to the platform about adding ourselves to the list of products on that platform.
Fantastic. And tell us about the team as the business grows. Are you expanding?
We are expanding the team. Obviously, distribution is somewhere we've expanded recently. On the investment team, we feel pretty good about where the investment team is today. I think with 10 to 20 companies and 4 analysts on the investment team, we feel well covered. One of the things I wanted the guys to do was get their CFA, and they've all now passed levels 1, 2, and 3. 2 of them are now just waiting on the charter to come through when they get their work experience. But that was one of the key requirements. I wanted them to have a passion. I want to get the CFA. They've kind of completed their studies now, and we're excited to get busy making money.
I haven't been through that, but I've heard it's a pretty intense process.
Yes, don't do it when you're married. That's the advice I give people. So it's an interesting process, but you get a lot out of it. I mean, for me, it was one of the best things I ever did. Obviously, coming from law, it was essential, but look, there's a lot of value in it, and we'll always favour employing analysts who have their CFA qualification.
Yeah, fantastic. I think it's pretty much running through the profession at the moment. There's a lot of people getting some more extra qualifications and acknowledging that it's definitely worth it. So, Lachlan, thanks so much for coming and chatting to me today about the company. Really appreciate it. It sounds like it's some exciting times ahead.
Thank you, Fraser. Thanks for your time. I really appreciate it.